So there's this huge new trade deal between Canada and China that's making headlines. Now, on the surface, it looks pretty good. Cheaper cars for everybody, new markets for Canadian farmers. But if you dig just a little bit deeper, you find a high-stakes gamble that could cost Canada its entire auto industry. So let's get into it. What's the real cost here?
Okay, so the deal itself seems pretty straightforward, right? Canada agrees to slash its tariff on Chinese electric vehicles, bringing it way down from 100% to just over 6%. And in return, China lowers its own pretty steep tariffs on Canadian farm products like canola. Sounds great on paper, a total win-win. But is it really?
Now, of course, the government is selling this as a massive win, a landmark partnership. They're talking about it as a breakthrough for consumers who are struggling with crazy high car prices and a way to build a stronger economy. But when we start to look closer at the potential fallout, a much darker picture starts to come into focus.
All right, let's start with the first domino to fall, the immediate and pretty scary impact on Canada's own auto sector, which, is the backbone of its entire manufacturing economy.
You can bet unions and industry leaders they were not happy. They sounded the alarm right away, and their main point? There's just no way to compete fairly here. They're saying this deal puts Canadian jobs right on the chopping block, all while rewarding what they call China's unfair trade practices.
And when you look at the numbers, it's just staggering. The labor cost difference is 10 to 1. And get this, that's before you even factor in China's gigantic state subsidies. We're talking over $230 billion poured into their EV industry since 2009. I mean, how are you supposed to compete with that? You just can't.
So naturally, you've got provincial leaders, especially in Ontario, which is Canada's manufacturing heartland, basically screaming from the rooftops. They're warning about a devastating flood of cheap imports that could hollow out the entire domestic industry and threaten hundreds of thousands of jobs, not just in the assembly plants, but in the whole parts supply chain too.
Okay, so this isn't just a Canadian problem. This deal immediately puts Canada in a really awkward spot with its #1 trading partner. Its most important economic partner by far, the United States. Think about it. For decades, North America has had this industrial alignment. The U.S. has been actively trying to move critical supply chains away from China. It's called friendshoring. And by pivoting towards China, Canada's kind of breaking ranks. This whole deal just flies directly in the face of that strategy, and at a time of really tense global relations. And here's where the timing gets, really, really bad. There's a super critical, high-stakes review of the entire North American Free Trade Agreement, the USMCA, coming up in July 2026. And this EV deal, it's now this giant sore thumb sticking out, giving the U.S. a ton of leverage to make some serious demands. So what could the U.S. do? Well, experts are warning they could make it a whole lot harder, maybe even impossible, for Canadian-made cars and parts to get into the American market. They could tighten rules, ramp up border checks over cybersecurity fears, or even worse, they could threaten not to renew the USMCA unless Canada backs down. And if that happens, it would be absolutely devastating for Canada.
But believe it or not, the risks actually go even deeper than that. This whole thing shines a spotlight on a massive strategic vulnerability that sits right at the heart of the world's transition to a green economy.
Simple fact, to build any EV, you need a bunch of stuff we call critical minerals. These things are basically the foundation of the 21st century economy. And when you look at the global supply chain for this stuff, one country is basically holding all the cards.
See, China doesn't just dig this stuff out of the ground. It completely dominates the complex, expensive process of refining it. In fact, between 2020 and 2024, pretty much all of the new refining capacity for key battery minerals in the entire world, it was all built in China. All of it. And this is where you get this potential Trojan horse situation. Canada is sitting on huge mineral reserves, right? But the problem is we don't have the facilities to refine them. So this deal could actually force Canada to depend on Chinese state-owned companies and their technology just to develop our own resources, basically handing over control and making Canada even more dependent.
And look, this isn't some what-if scenario. China has a track record of using this dominance as a political sledgehammer. It cut off rare earth exports to Japan way back in 2010 during a dispute, and just recently it put in new export controls. All of which just proves they are more than willing to weaponize these supply chains when it suits them.
So when you start putting all these pieces together, all these dominoes from local job losses to the geopolitical mess to this resource dependency, analysts are warning that it all points to a really grim potential endgame for Canada's whole industrial base.
In fact, experts have kind of mapped out what this could look like, a three-stage collapse of the Canadian auto sector all kicked off by this one deal. First, all the uncertainty makes investment just freeze up. Then, because they can't compete, plants start to close. And finally, the U.S. retaliates, cutting off the main export market. And that's the final nail in the coffin.
And, as former diplomat Michael Kovrig points out, this isn't just a Canada problem. This is a pattern we're seeing all over the West, in all these democracies that are facing a flood of state-backed overproduction from China. The big difference here? Canada seems to be rolling out the red carpet for it.
So when you boil it all down, the bargain being struck here is basically trading the very foundation of a high-wage, high-value manufacturing economy for some short-term help for farmers and a cheaper price on a car. It's a trade-off, for sure, but it's one that a lot of critics think will have some really severe long-term consequences for Canada's entire economic future.
And that leaves us with a really fundamental and honestly a pretty unsettling question about the country's economic future. Is a short-term gain really worth risking a century-old industry and all the security that comes with it? The debate over this is really just getting started.